Hello, everybody, and welcome to another episode of the podcast here, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax solutions options. Also, finding ways to create and preserve more wealth. Each and every episode, we're bringing on some of the best real estate, financial, wealth, and business minds in the world, where they share their ideas and deal stories, so we can help scale our businesses, make more passive income, have creative tax flow solutions, and overall just give you an edge in business and in wealth and in growth. I'm excited about our next guest. He's out of the great state of Florida, and he's on a mission to help us, invest and make the most of mobile home park investing. And maybe you're seeking a stress-free investment that can provide protection from a market crash. Something that's against the stock market. Well, this next guest started in real estate after ending his professional baseball career in 2015, and then he joined a publicly traded real estate investment firm that transacted over $46 billion annually. And then he acquired assets and disposed of commercial properties in the multifamily apartment sector for investors spread throughout the various U.S. markets. And then he started a full-time commercial real estate brokerage in 2019, specialized in multifamily property in the Southeast, before partnering up with his partner at MHCI Group, which is mobile home park investing. 16 parks now, multiple states. Please welcome to the show with me, Jason Postill. Jason, how we doing?
Hey, Brett. Thanks for having me on. Really appreciate it.
Absolutely. For our listeners getting to know you for the first time, could you give us a little bit more about your story and your current focus?
Yeah, absolutely. So again, Jason Postill, co-founder at MHCI Group. We're based out of Florida. A little bit just about my background. Thank you for the intro. But I didn't have a real estate background. So out of college, I was fortunate to continue playing baseball professionally for about 5 years, but I always gravitated towards commercial real estate. Didn't have family in the business or really friends, but I heard a big leaguer my last season at a pro camp. I played with the Tigers, and I remember him saying he did not make his millions playing baseball. He made it owning 1,000 units in South Detroit, right? Apartment building. So it's like, oh, bingo. That was where I started trying to learn more about apartments, and definitely didn't just jump in, start investing. I got in on the brokerage side and worked with some larger outfits and really learned the space. And about 2018, about 2017, I ended up going independent, and I didn't have a 401k or really my investment. I was just brokering, right? So I said, well, it's time for me to find all these deals for everybody else. Let me start to get on the other side of that. So started really just analyzing the different asset classes and so many food groups, right? You got retail, industrial, different subsets of even multifamily, right? And just really analyzing, seeing market cyclical, right? Up, down, what's one of the top performing or the top performing assets. And mobile home communities kept popping up, and I didn't know anything about them. Kept hearing different things, right? Like, oh, you just own the dirt and collect the dirt, and come to realize for the listeners that is not the case. But we'll dive into a little bit, I'm sure later. But started really seeing that mobile home communities was one of the top performing asset classes across the board, and just seeing the demand for affordable housing and the lack of supply. Right? We always hear about it. We always hear affordable housing crisis, but yet they're tearing more of these communities down than they're developing them, right? And some could argue and say, oh, they're putting up a new park down the road, but it's not, right? It's a resort style, maybe RV park. So in about 2020, I did close with my business partner. I think he's going to be on your show as well. He's operations on the ground, and we met through a funny story, but we closed our first deal in Arkansas, Little Rock, Arkansas, and it was a 68 unit 2-park portfolio, and from then on we scaled to just under 700 units throughout the state of Arkansas and 16 communities.
Got it. Awesome, Jason. Absolutely cool background, cool story. Baseball to broker to mobile home park syndication and general partner. Really cool. Jason Postill, everybody, mhcigroup.com, mhcigroup.com. So let's dive right into the topic at hand, which is this, Jason. What's the number one secret to why mobile home parks are still the best investment?
Yeah, so just to go back to kind of what I was saying, analyzing. I mean, there's arguably different asset classes, right? We've looked into storage and different, but I would say, we're behind food, water, and shelter, right? And I know apartments have always been the sweetheart, and financing is tough, but again, having uh, lot rent, ours is averaging $350 lot rent. So you go through hard times, you can pretty much put that on a credit card, right? It's tough to put that on a $2,000 for a one bedroom. Sometimes for people, tough times to put that on a credit card or make that payment. So just again, studying and seeing the collections it's the lowest form of detached single family housing, right? That you can still own and buy. So that, just again, studying and just seeing the demand and our tenants, our prospects, they're we have a line out the door. So we're just trying to keep up with filling units and keeping up with the demand.
Okay, yeah. So it sounds like plenty of demand, and then not a lot of affordable housing, right? We know that it's one of the top, three, if not top, five crises in America, right? And it's not slowing down; it's only getting worse, and it's really difficult. And so the $350 versus the $2,000 rent makes a lot of sense. What's the number two secret to why mobile home parks are still the best investment?
So yeah, the owning the dirt, I did hear that coming in, which I'll touch on now for the question, but it is not as simple as owning the dirt, right? Our model is we sell the homes off. So we have tenant-owned homes. It's over about 85% of our portfolio. The tenants own the home. So the expenses, when you eliminate owning the homes, you're eliminating that expense ratio, right? So instead of a 50, 55, 60% expenses, you're trimming those up. We have some parks operating at a 24%. Usually when I see that from a broker or when I underwrote, that can't be possible, right? And yes, we have some that are towards a 40, 42%, but the expenses are light. And if you eliminate that expense by the tenant-owned home model, then, in our opinion, that makes it, again, one of the better investments. For sure.
Okay, so it sounds like the other two secrets is you can actually decrease your expense ratio, right? And when you do that by selling the homes off, you can lower that, which is nice versus other assets where you can't do that. I think that's what you're saying there. What's the number three secret to why mobile home parks are still the best investment?
So mom and pops, we're now growing to, like I said, under 700 sites. We have just under 300 under contract right now. So we will be crossing the 1,000 mark, but there hasn't been a lot of institutional ownership in what we've bought. So the barrier to entry, now it's getting more hyper competitive, obviously, but where we capitalized on the opportunities was those small to mid-size. So we've had 18 units, 33. Our largest asset to date was 122 units, but no institutions are looking at those. And so, we were able to find the small to mid-size and really just direct to owner. And we've leveraged some broker contacts for sure. But, the competition in that mid, that's what, made for us to find the better deals.
Okay, cool. That makes sense. Yeah, mom and pops, and has been over concentrated with big institutional buyers. So let's walk through a couple deals. Maybe we can do like the last one you bought or last two you bought, and just kind of get a feel for what those numbers are. Is that all right if I ask you a couple questions, we kind of underwrite it together?
Absolutely, sure.
All right. Can you tell me? I guess the first thing would be how many units, right, or how many lots, or however you want to put it, right? And then what was the price? What was the average, rent for that piece, that unit?
Yeah, so one of our better last deals, it was 122 sites total. That was the largest one I was talking about. It was one clean parcel. Average lot rent there was 100, and at the time it was $150 for some of those. So even though I mentioned 350 is our average, this was in a little bit different market. So we went up to 250. But all the tenants own their homes. We bought it for $2 million, where for 122 sites, it was a great deal. It was in a trust. It was starting to go downhill. There was a lot of delinquency, but market is still at 300. We will get there next year, but we're at 250 right now. But it was 100% full with homes, so it wasn't a big project, which most of our communities have been projects where we're having to bring in homes. But this was a more stable asset in the sense of homes were already filled.
Okay, so I got that. So it's 122, is averaging about $150 in lot rent. What was the total occupancy at the time of closing?
So the occupancy was 100% at closing. It just had 30% of delinquent payers that hadn't paid for some of them 6 months or more. But it was 100% with homes that were on pads full of tenants.
Got it. So 70% collections, right? So got it. So basically, yeah, it's even worse if they're just, you have a new evict or get them out of there. I wonder if you have some stories with that, that'd be kind of cool. But let me keep going to these numbers before we dive into that. So I'm going to take a 122, right? And I'm going to times that by 150. And that's going to give me about 18,000 a month, although I'm going to take off 30% of that. So that's like 12,000 a month, right? Because you got to work through that. I'm going to times that by 12 right now. It's 153,000 divided by, now you said the expense ratio was that, because it's not owner owned, it's tenant owned. Was this a 24% expense ratio, or you feel like this one, what do you think this one was?
This was a standout. That's 24%. So it's direct bill, the utilities, it's clean. So it is our only asset that's in that 20, and that's the 24%. Correct.
Okay. And that includes, for you guys, just to clarify, property insurance, property taxes, right? Any utilities that you're paying. It includes repairs and maintenance, management fees. This is everything. You're saying it's only 24%?
That's right. Yeah. Yeah. We were combing through the P&Ls. Yeah. I mean, you got general liability insurance. Yeah. The taxes we pay manager there, $1,200 a month, and $350 for some landscaping. It's pretty lean and mean. Okay.
So I'm looking at like a 6 cap on that 30% ratio, of the going, it was a 6, right? But then now let's talk about, well, it's not just a 6, because you're going to start getting these units that are not paying, either to pay or to get out. So walk us through, how long did that take? And then what is the average rents now that you've had a chance to get that out? And what's the average occupancy? Now, average collections would be a better word to say.
Yeah. So we've only had, so what worked really well for that, we actually were raising money for legal. We've said, okay, 30%, that's a big number on 122 units. So we're going to, and we've done evictions. So we had a pretty good idea of what that would cost, but we went in and told everybody, hey, we're going to wipe the slate clean. Okay. So if you owe 1,000, 2,000, whatever it is, we're wiping the slate clean. But if you don't pay by the 5th, that's, first through the 5th is when payments, then we're going to initiate the eviction. We're going to start the eviction process. And believe it or not, we had 98% collected after that. And that hasn't happened before either. So again, this is a standout shining star, but we had 98% collections. We ended up only having to evict one person. That wasn't even on a non-payment. It was other violations, but yeah, it worked out really well.
Okay, pause there. Okay, so that sounds really cool, right? So you go to them, you're like, look, the past is the past. We forgive that, or it's not even with us. Like, it's that guy's gone, but moving forward, you've got to pay on time. We're going to evict you, but we'll wipe that out. Okay, got that. Was it at 150 or 250? What was the number?
So we did it with, they saw we were coming in, did some improvements, right? There was some we put a little bit of paving down in some rougher areas, did landscaping, new signs, brought up kind of just the general aesthetics. So they realized, okay, we're not just coming in there raising rents, but they realized that if we were willing to wipe the slate clean and then do improvements, that we were coming in as new ownership, new management team, and making the community better, right? And if there was any bad apples in there, they were going to get evicted anyway, and the tenants appreciate it. But yeah, we sent out the letter day one, and yeah, by the next month, we did tell them there was going to be improvements in the community and give them a heads up on the increase. And
okay. Everybody, what was the amount?
I'm sorry?
What was the amount? Like, what was the increase? What was the total that they're paying?
Oh, 245. So
got it. And how about the other 150? Are the other 150 paying 245?
Yeah, it went to 245.
Okay, everyone's at 245, and at this point, you're 98% collections on 245. Is that a fair summary?
Correct. That's right.
Okay, so now let's do the math, right? So we're going to take 122 by 245. This is the cool point. Now yet, and we're going to take what was it called for 0.95 just in case there. So 28,000 times 12 is 340. Now we're at 340,000. Now we're going to take that expense ratio 75%, basically 25%. So we're at 255. Divide that by 2 million. We're at a 13% cap rate. Not too bad, Jason. Now, how much did you put into the property for the improvements?
So we had 40,000. We had some lift stations. So we had about 100,000 total that was it was like 75. Yeah, lift stations. We had to repair 2 lift stations, even though it was on city water, city sewer. Then we did some paving. Yeah, it was just under $100,000.
Okay. Yeah. So just call it 2.1. You're all in, right? And you're taking the 255, which is the approximate NOI here, by 2.1. That's a 12 cap. Like, hey, that's pretty sweet. When did you buy it?
So we bought it. It'll be two years this year. And the beautiful thing on that deal, the 13% cap rate. I mean, we love cap rate, paying attention to it, but the cash on cash is what was crazy. I mean, we're in the 22% plus because of the way we structured the deal. The seller actually held, I didn't mention that at the beginning, it was $2 million, but the seller held a second for $500,000 for some favorable terms. And we only had total all in 500,000 on total in the deal, 500,000 cash in the deal. So we're now distributing. We were doing 10,000 a month. Now some months we did 20, but just in that first year we were doing 10,000 a month. So on the 120 net cash.
Okay, let's try. I'm going to test you on this 20%. You ready? Because this is what we do every single day. You ready, Jason? So let's see if you got it. And I'm going to trust that you got there, right? Well, let's just see though. Okay. So on that $500,000 seller carryback, what was the interest rate?
So it was a 4% IO.
Okay, 4% IO. Mm-hmm. Okay, so 4% IO. Nice. I like that. IO for how long?
It was 7 years.
7 years. Excellent. And it's just fixed at 4%?
That's right.
Yeah, nice job there. And then how about on the other, the 1.6 million of debt?
So we had, that was,
we put 500 down. So I guess it would be, so now you're at,
that was right when rates were jumping. I'll clear this up. It was around 4, it was in the 5, it was right at like a 5.25, 4.75. And we had some interest only.
Oh, okay. Nice. So yeah, so you got 4.75 on the other, let's just call it, cause you got $1 million between these two. So then you just have about another $500,000 there. So good. Okay. So 4.75, and so I'm going to take 500,000 by 4.75. That's about 23,000 of debt service per year, right? Is it principal and interest, or is it just interest only on that one?
Interest only for, it was the 6 months P&I on a 25-year AM.
Okay. I don't know what your debt service is on that, but let's just call it 30K on average per year. Let's just say on that one. And then on the other one, it's IO for 7 years.
The seller carry on the 5.
Oh my gosh. You guys, I mean, that's incredible, especially with where interest rates are at now. Right. So, I mean, so that's like 20K a year there. Okay. So 20,000. So you guys are magicians to get that one. So that's 20K. So, okay. So I'm looking at about $50,000 of debt service. Is that about what you have there on your total per year?
We're paying more than that. So I would say it's, you said you penciled out 50. I would shoot more as 80,000. Call it 80. I'd pad that a little more. Yeah.
That's fine. That's 80. Right. And so then we're going to take $80,000 as the debt service, right? And we're going to put that here. And then we're going to, by here, I mean, my HP 12C is what I'm using. By the way, I'm a commercial real estate.
You're going to be on. Yeah. You sharp. Yeah.
Sorry, Marcus and Cap. And so we're underwriting this live. If anyone wants to you should get this calculator. It's pretty cool to do this. And so remember, our NOI was about $255,000, right? Is what we calculated it to be. So 255 is the estimated NOI. And so we're going to take that, and we're going to minus the 80,000 of debt service. So that gives us about 175,000. Then we're going to take that, divide it by the $500,000 down payment, plus they added, is it $100,000? Is that out of pocket as well, Jason, or was that a part of the debt?
Oh, the 70,000 was out of pocket. Yeah, we didn't get a construction loan, so add it. Yeah, because I think if you,
I'm going to add 100,000 to that down payment, right? In a sense, right? Because that's essentially what it was. So now we take 175 divided by 600. I'm seeing 29%. If those are the numbers, even at 80K of debt service, so it's even better than 20.
Yeah, 22.5 is what we penciled out, and yeah, I mean, again, we're now distributing a little more, but. I'm not going to get on here and say, oh, we're crunching 30%, even though, some months it could definitely be.
Yeah, I hear you. It could fluctuate there. By the way, this is Jason Postill. If he's doing deals like this, you're going to want to know him. You want to go to mhcigroup.com, mhcigroup.com to learn more about why the mobile home parks are the best investment and ways to invest. So Jason, what any live deals you have now that you're raising for, you're looking at, or like what are you seeing out there as far as opportunities?
Yeah, it was challenging. Last year we did push the deal across the finish line, but we had such a good outbound campaign for the last 4 years, just hammering in a concentrated market, where we've had now sellers come to us. They see that the offers aren't maybe as strong, and I don't want to say they were getting greedy, but I think they were getting greedy the last 2020, 21. But yeah, right now we have 281 units under contract across 2 parks. So that's 2 mobile home communities in Arkansas, again, where we own and operate. And we're getting into those at around 7 million. It's a larger asset. So, we are, paying for scale here, but it's still a great deal. One deal's 195 sites for 5.1 million, which, in the market, we've seen trade, 230 units for 13 million. So we feel we've got some building equity.
Yeah.
Day one, and it's going to be another home run for sure.
That's awesome, Jason. I love it. I love mobile home parks, multifamily mobile home parks, parking lots. Those are cool. I like some industrial, right?
Okay.
I like RV resort. Those are probably my 5 of the favorite food groups when it comes to investment real estate. And especially when you have the value add, where you can go from $175, $150 to about, let's call it $300, right? Or 250, like that's fantastic. And then if you then it's all about terms, with the debt, right? And the interest, like, man, you got tax flow, you got cash flow going, you got debt flow going well. You're getting all 3 of these connecting in a sweet deal. Then it's a home run. So way to go on that, Jason Postill, everybody. POSTILLMHCI group.com. I want to geek out a little bit about capital gains tax, Jason. Most people think that the 1031 exchange is the only way to go, and they get caught in these what's called the shotgun wedding. They're racing around with their hair on fire. They're trying to buy that deal. The brokers are excited because they know they got that deal lined up. They're going to get it. But the seller's like, man, I got to go overpay. And then either I overpay and get too much debt and not enough liquidity diversification, or I'm selling a business or cryptocurrency and I don't even have a 1031 option because it's not eligible. But the worst part is, like a commercial real estate syndicator like yourself, you want people to be able to come into your deals, but they can't unless you do like some tenant in common carve out, which is kind of a needle in a haystack sometimes. Enter the deferred sales trust. It's a solution to defer capital gains taxes without having to force a 1031 exchange. So I'm curious, Jason, with your background, everything we just talked about, what would it mean if people could exit $100 million of Bitcoin, defer all the tax and go into deals with you or another property or real estate, all tax deferred, no timing restrictions, no like-kind placement requirement, Reg D, passive deals or syndications, all of that. What would that mean for you in the industry?
Yeah, it's a beautiful, and I don't know much. That's why I would love hearing you share about it, because we have had a lot of investors, and yeah, the 1031, like you said, the JTIC, that's unique. And for our, not saying we can't pivot on a deal by deal basis, but for this fund we're raising right now, these 2 deals, it isn't set up to accept those. So we are unfortunately having some investors sit out on the sidelines on some of these deals because a vehicle like that isn't in place today, in our pipeline. So yeah, it definitely helps, and we're trying to talk through and learn some new ways to help our investors.
Cool. If people want to learn more about that, you go to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. We also wrote a book on it called Building a Capital Gains Tax Exit Plan. It's my journey from Marcus and Milch as a broker to help people not only do 1031s, but then to do a deferred sales trust. Now they feel trapped by capital gains tax ever again, but also works for cryptocurrency, business sales, works for primary homes. And it can also save a failed 1031 exchange in case you want to go for your 1031 exchange. In fact, we just released the best 1031 exit plan. Go to experttaxsecrets.com to learn more about that. You never want to get caught in a 1031 without a deferred sales trust as a backup plan. And sometimes you want to do both. And we're here to help you here at Capital Gains Tax Solutions. Execute on that. Pick up the book. Go to capitalgainstaxsolutions.com or experttaxsecrets.com to learn more. That being said, Mr. Jason, are you ready for the lightning round?
Let's do it.
All right. Knowing what you know now, if you go back to your 25-year-old self, what's the one golden nugget to make sure you tell yourself to do?
Hey, get started. Get around people doing it, and don't be afraid to ask tough questions.
Excellent. Number 1 book you've recommended or gifted the most in the past year?
The One Thing, Gary Keller.
I love that book. It's such a good book. I got to read it again. Next question. What are you most curious about?
What's next? How can I get better? What's changing? How can I get ahead?
Love it. Number one leadership book or theme that you strive to live by?
Leadership, lead by example. Or these short answers, I don't want to get too long-winded because the lead by example. Again, sports background, having coaches bark at you if they weren't able to do it. I always respected that. So, in the business world, it's the same. If I can't get on the phone cold call in front of you, or someone hangs up on you and I don't call them back and show you how it's done, then follow, lead by example.
Absolutely love that. Second to last question: number one way that you're using Chat GPT.
I'm sorry. Number one way to use.
That you're using it. That you're using it.
Yeah, I'm still trying to learn it. I know it does clean up some articles and some posts. So, maybe giving me the cliff notes on some articles has been pretty good.
Right on. Last question. After all your success, helping all the people you've helped achieve all you've achieved, how do you best stay centered in your values, Jason, and then stay encouraged to charge forward to reach even higher heights?
I always put God first. God-fearing man. So, give it to church. Always give glory to God. That's first and foremost. Everything
Amen.
else.
Amen and amen. Jason, I want to thank you for being on the show, sharing your wisdom on mobile home parks, your success, underwriting in a live deal with me, on the fly. That was awesome. And finding a great deal, right? I would encourage you to keep using your gifts of hard work, modeling what works and leading by example, and then finding great deals for people to investigate some passive freedom in their wealth plan through mobile home park investing. For our listeners who want to get in touch with you, would you mind one last time, what's the best place for them to find you?
Always on the email, jason@mhcigroup.com or the website, mhcigroup.com. Always
awesome. Thanks, Jason. Hey, I want to thank everyone else too for listening to the episode. Multiple podcasts. We're streaming on Capital Gains Tax Solutions, Build It to Billions podcast, and Expert CRE Seekers podcast. As always, we believe most high net worth individuals and those who help them, they struggle with clarifying sometimes their capital gains tax deferral options, or finding amazing deals with operators like Jason that have a track record, working through ways to structure and underwrite deals. And so we want to bring you actionable knowledge today that you can use to help you create and preserve more wealth, make an impact. And we also encourage you to give as much as you can away for those that are most vulnerable in this world. We so appreciate everyone watching today. Please rate, review, subscribe, share it with somebody, and we will talk to you again sometime.